All right, that was a signal. We'll let people keep filtering in. We'll get started. Just be cognizant of everybody's time. So hello, welcome to our latest UCI Alumni Adulting for Anteaters. This is a virtual program hosted quarterly, built specifically for the UCI Young Alumni. And we cover a wide variety of topics. Many of you may have attended our stocks event, which proved to be incredibly popular this last spring. And we wanted to invite Professor Chris Schwarz back to do a deep dive in the world of cryptocurrency. As we all know, this has been a big topic recently. My name is Sai Upadhyula. I'm a graduate of the UCI School of Law and a member of the UCI Young Alumni Council, or YAC, which is a group of volunteers made up of graduates of the last 10 years that helps guide the Alumni Association in strategy to engage recent alumni, which is the majority of UCI alumni. The school is growing by leaps and bounds, and the UCI Alumni Association, through the UCI Alumni website, has a ton of virtual resources to help you feel connected and engage with fellow alumni. So take a look at our upcoming events calendar, library of past programs, mentoring on the Anteater Network. That's an innovation of the Young Alumni Council. We're very proud of it, and more. And all in all, don't forget, we're all in this together. So the attendees are all muted in order to eliminate background noise and interference. However, we would love for you to participate as the event goes along. You can use the Zoom Q&A function, submit your questions for our speaker Q&A portion. That will take place towards the end of the hour. You can also feel free to network in the chat. There are a lot of you. However, despite the temptation of the topic, please avoid using the chat to advocate for particular currencies or otherwise give direct financial advice. This presentation is in no way intended to serve as financial advice. It is for educational and discussion purposes only, and maybe some entertainment. Our speaker today is Christopher Schwarz. Dr. Schwartz is an associate professor of finance at UC Irvine's Paul Merage School of Business, as well as the faculty director for the Center of Investment and Wealth Management. During his time at UCI, he's been published in essentially all leading academic and practitioner finance journals. His research has been cited in the New York Times, LA Times, Wall Street Journal, Financial Times, all the times, and provided a number of economic forecasts in the community. And prior to arriving at UCI, Dr. Schwartz received his PhD from the University of Massachusetts Amherst, during which he was also a visiting doctoral fellow at Yale University's International Center of Finance. Let's give him a big Anteater welcome, or welcome back. So Chris Schwartz.
Well, thanks for having me back, and really appreciate everyone coming back. And I'm sure this will be an entertaining topic for everybody. So I look forward to all the questions that you all have, and hopefully you learn something and enjoy the information here, regardless of how you feel about crypto. So just before we get started, just some disclaimers. I think one of the pre-questions is about what I own. So I have no conflicts of interest in what I'm about to present. I don't own nor am I short any individual stocks, especially bank stocks. I own none, nor am short any cryptocurrency. So I've played around with them just so I can understand them better. I received no revenue or job credit for this talk today. So this is just because I want to help educate. I'm not consulting advertising for any bank or cryptocurrency or Delphi startup, and everything is just my opinion and not any investment advice. So I've got no financial bone to pick with either side of this debate. I'm just going to kind of try and frame how I think about cryptocurrencies and about Delphi and everything within the standard frame of finance. I'm not going to talk a lot about the technical things that maybe some of your UCS majors are more interested in. I'm going to kind of gloss over a lot of that because I'm a finance guy. And so it's not that interesting. So before we get into cryptocurrency, I want to talk about some basic economics before we get into cryptocurrencies, because I think that's going to help frame, kind of how I think about cryptocurrency. So I'm going to talk about what properties do you need to have something be a currency. I'm going to talk about why fixed supply things can never actually be a currency in a modern economy. I'm going to just explain briefly what a financial asset is, what a commodity is, and then I'm going to kind of debunk what I consider two of the common financial misunderstandings that a lot of people have, and I'm going to say a lot of anti-US dollar people have that just aren't true. And then I'm going to go ahead and start talking about cryptocurrencies. All right. So first of all, what properties does a currency need, or something need to be a currency? So the first and foremost, it has to be scarce. The reason you have something like sand is in currency is because it takes you like 3 tons of sand to buy a loaf of bread. And so you have to have something that's scarce. You have to have a no counterfeiting problem, right? So if you have something that's currency, but I don't know if it's real or not, then you have a problem. It has to have a stable value, right? So if I have money today, I know what that money is going to be worth tomorrow. Otherwise, I'm not going to store my wealth in it. So you have to have the ability to account for wealth. You also have to have low inflation. So, whatever I can buy today at some price is the price I can basically pay tomorrow. And then the other thing is you actually have to have an economy that goes around the currency, right? So if I have a bunch of money, but there's nothing in the economy I can buy with it, then is it really functioning as money? So if you take a country like Venezuela, they have a physical currency, but nobody actually uses it because if you try to go to the store and buy something with it, there's nothing to buy. You basically have to barter or try to find what they call hard currency, which is US dollars or something else to be able to buy anything. And if something goes terribly wrong, this is a picture from Germany in the 1920s. They had 100 million% inflation in Germany. And you can see this woman is literally stuffing Deutschmarks into a furnace because this money itself had more burning power than the wood that she could have bought with the money. All right, so this is obviously something that has stopped functioning as currency. And so this is one of the problems currency needs to avoid. All right, fixed supply things never work as a currency in a modern economy. So let me explain very quickly, right? So just imagine a world where you only have 2 things, right? So we just have 2 things in this world. So one is you have one house. So you have one house in this world. And the other thing you have is you have 1 kilogram or 1,000 ounces of gold, right? So these are the only 2 things that exist, all right? And so obviously based in this world, the value of this house must be 1,000 ounces of gold. What else are you gonna do with your gold, right? You can't do anything with it other than buy the house. All right, so just imagine next year, all of a sudden now there's 2 houses, right? So we got the 1 house and the 2 house, but there's still only 1,000 ounces of gold. Well, just by definition, the total value of these 2 houses can still only be 1,000 ounces of gold, which means the average price of each house now is 500 ounces. So essentially, this first house that you have here probably went down in value by 50%, right? Not because the house isn't more valuable, just because, there's only so much money to buy both things. And so both things on the average have to be worth 500 ounces of gold. Now, this doesn't, of course, work in a modern economy because if the value of this house goes down by 50%, then if you have a mortgage on this house, you're going to stop paying the mortgage. If your salary goes down by 50%, you're going to stop paying your mortgage. And so essentially a fixed currency and a growing economy equals deflation, right? And you can't have deflation in a modern economy, right? Because what will happen is everyone will default on your loan and that's the end of the economy, right? Pretty much you can know from the Great Depression or in 2008 when housing prices crashed exactly what happened to the economy. And so this is why things like gold or other things that are fixed supply are generally not currencies anymore because they just simply can't keep up with a growing economy, right? If you wanted these 2 houses to be 1,000 ounces of gold, that's their value, then you need to grow your currency by 100% so that the values stay the same. All right, what's a financial asset? A financial asset is a piece of paper that's a claim on future cash flows. It doesn't create anything. It's not a factory. Many times it doesn't actually have any physical properties. For example, a stock or a bond, you used to own them electronically. Now there are stock certificates, but nobody gets them. And essentially a financial asset lets you turn 1 unit of currency, so a dollar, into more than 1 unit of currency, right? So of course, if you think about bonds or stocks, or excuse me, bonds or debt, you lend money, you get your money back plus interest. Stocks, you invest your money, you can get capital gains, you can get dividends, right? So financial asset is a claim on future cash flows. And it's going to grow over time because, of course, you're going to get money back for your investment. Please note something like gold is not a financial asset, right? So gold, if you put 1 ounce of gold in a safety deposit box and you come back 100 years later, you will still only have 1 ounce of gold. There's no cash flows associated with gold. There's no dividends associated with gold. There's no interest payments associated with gold. You'll just have 1 ounce of gold. All right, what's a commodity? All right, so a commodity is basically something that's all the same. That's why it's called a commodity. And generally have some basic use or function. All right, so common commodities are things like oil, natural gas, gold, platinum/palladium, which is used in catalytic converters, copper, et cetera. And then you have food examples like corn, wheat, beef, pork, et cetera. Right? So these are physical assets that have some kind of use in the economy, right? Even gold, people think about gold as like a reserve currency, but really gold also has, of course, use in jewelry. All right, so 2 BS statements that I want to go ahead and demyth pretty quickly. So this is one of the statements that drives me the most nuts out of pretty much everything I hear about the US dollar. The US dollar has lost 90% of its value since 1955. right? And so, of course, what somebody did was they took $1 here back in 1955 and they applied inflation over time and say, see, now that $1 from 1955 is only worth like 10 cents today. In other words, something, you know, that I could buy in 1955, now I need 10 times more dollars, and I need $10 now to buy the same thing that cost $1 in 1955, hence the dollar sucks. All right. This is just a super lazy way of thinking about the dollar, right? The only way this applies is if in 1955 you pulled a Walter White and you put all of your money in a storage locker and just left it sitting there for the next however many years it's been. What has it been? 66 years. And of course, then the value of your money has gone down. But no rational person does this, right? They actually use their dollars to invest in something. And even if you bought something simple like a 3-month T-bill, right, you would have still outperformed inflation. In other words, you'd have more purchasing power today with your money than you had back in 1955. Do you have more dollars than you had back in 1955? Of course you do. Has there been inflation since 1955? Of course there has. But in other words, the financial system has more than compensated you for your money, and you've lost zero purchasing power unless you kept your money in a storage locker or under your mattress or in the backyard. All right. So this whole idea that it's been terrible to own US dollars since 1955 is just a sad joke. I'm pretty sure that no one would advocate, if they could take a time machine back in 1955, that you should have sold everything you owned in dollars and owned something else. It's been the best functioning financial system and performing financial system in the world. All right. Second thing that really makes me mad is that people talk about the banking system ripping them off. And this is the example here. So the banking system might be ripping you off, but this is not the example that you can use. So I am a Bank of America customer, and I have money at my Bank of America account, and they pay me 0.1% interest. And then I run down to Bank of America and I get a 30-year mortgage, and they charge me 3% interest. What the hell's with that? I'm getting ripped off, right? I'm paying them 2.99% extra interest for this mortgage. It's not fair. They're ripping me off. How come I'm not getting 3% in my checking account? All right. Again, this is not the right way to think about it. These two products are not the same product. All right. Just think about it. You can't lose money in your savings account. If you buy a 30-year mortgage, every single day, the value of that mortgage based on interest rates can go up or down. It's got risk, right? Your mortgage could default. I mean, everyone doesn't think they're going to default on their mortgage, but you might. So you have some risk that you won't actually earn 3% because someone defaults. And most importantly is you have liquidity. You can go down to the ATM or the bank or Venmo or whatever, and you can use all of your money in your checking account. But if you put that money in a 30-year fixed year mortgage, guess what? You have no access to the money, right? You have to wait for someone to pay off their mortgage over 30 years. And of course, if you're going to give up the liquidity of your money, you're going to actually ask for a rate of return, right? So these two things are not comparable. If you want to say the banking system's ripping you off, this is not the way to go. All right, so with all that out of the way, I know you're here to talk about cryptocurrency. So let's go ahead and get ourselves into the matrix here and talk about cryptocurrency. And I'm going to start here by talking about the OG cryptocurrency, which was Bitcoin. So believe it or not, the original tech for Bitcoin was created by a guy named David Charm in 1982. So he actually was the first one that came up with this idea of an anonymous cryptocurrency. And Bitcoin was actually started in 2008. It was registered in 2008 as bitcoin.org. And in early 2009, in January, the first tokens were actually mined. All right, so the rationale of Bitcoin at the time was to get rid of central banks. So this was during the financial crisis. Everyone was upset about central banks and blah, 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 that they caused the financial crisis. And believe it or not, the first transaction of Bitcoin was valued at, Bitcoin was at $0.0025 per Bitcoin. Someone set 10,000 Bitcoins to buy a $25 pizza in England, which by the way, makes that a $600 million pizza today if you were to do the math out. So that's pretty crazy. All right. Who founded Bitcoin? Nobody knows. It's some name that everyone's been trying to figure out for years now. I've had Pam Beasley, aka Pam Halpert from The Office, help draw up a sketch, and it kind of looks like this guy, I think. So this is the guy that started Bitcoin. Nobody really knows who it is, but that's okay. We'll keep moving on anyway. So what's the idea behind Bitcoin? All right, so the idea again behind Bitcoin is you have this central government thing called the Federal Reserve. The Federal Reserve controls how many dollars there are. There's no limit on how many dollars they can make. So you got this guy, Jay Powell right now sitting there, just, he's collecting his dollars and printing many of his dollars he wants and debasing the currency and blah, 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 blah. So instead of having a centralized source run by some guy that can print as much currency or some woman that can print as much currency as they want, we're going to go ahead and convert this and instead have a decentralized network, which I'm going to call Skynet for right now. And Skynet's going to go ahead and run based off a computer program, and it's going to create some currency. And at most, that currency can have 21 million coins. All right. The idea is instead of having a centralized source, you have a decentralized source. And instead of having a infinite amount of currency, you have a finite amount of currency. All right. So that's really the idea behind Bitcoin, to get the central government out of the way and to make sure that you can't print as much currency as you want. Right. So what's the tech behind Bitcoin? Well, Bitcoin runs on something called blockchain, which is a very complicated cryptography thing. I'm not going to get the details of the technology, but basically it has two things. One, you have a decentralization of what's called a publicly distributed ledger. So like every single node in the network has the complete ledger of all the transactions that have ever taken place. And of course, you have cryptography to make sure that people aren't hacking the network, that you have transactions that take place properly, et cetera. All right. And so kind of the shorthand version of what happens is you request a transaction on the Bitcoin network. That transaction is sent to the network. Some what they call mining occurs, which they call this proof of work. So essentially to make sure that there is not a counterfeiting problem. All right. That's what the proof of work is there for. So it's a complicated thing, but this is to make sure there's no counterfeiting. All right. So whoever gets the answer first goes ahead and gets credit for it, and they log it in as a verified transaction. All right. So basically the first person that solves a mathematical problem, which is very complicated, is going to get some Bitcoin. So over time, if you're mining, eventually you'll get some Bitcoin from doing a transaction. And of course, that's really how Bitcoin works. All right. So I'm sure that some technical person can say I said something wrong, but I think that's pretty close to an accurate description of what happens with Bitcoin, right? So again, the idea is you have a decentralized network, you have some mining that takes place, and your reward for mining, putting your resources in the network, is occasionally you get some Bitcoin from doing some mining. All right. Why do people like Bitcoin? And my number one answer is the price has gone up. I'm telling you right now, if the price of Bitcoin was still $0.0025, no one, pardon my French, would give two shits about what Bitcoin's doing. The only reason people care is because the price has gone up and they want to get rich. All right. There's a limited supply. This is probably way down the list after price. There's a limited supply, so people call it digital gold. It's decentralized, so everyone likes to stick it to the man, so to speak. So I'm sure some people out there are the stick it to the man crowd, or stick it to the woman crowd, or they crowd, or whatever the proper pronoun would be. So my apologies. And some people truly believe it's going to cut the cost of finance, and I'll talk about that more later. Right? Why do I say people care about the price? So let's look at the price of Bitcoin over time. So I'm sure I don't need to tell many people on this talk we're almost at the peak price of Bitcoin, and who knows? Right now we could be at a record high price of Bitcoin. Again, you can see it start off at less than a cent per Bitcoin. We had a peak here about 20,000 back in December 2017. It crashed, and now it's been going crazy ever since beginning of 2000. Basically since COVID started. You can see it crashed again earlier this year a little bit. Now it's back up again. All right, why do I say that people mostly care about Bitcoin for the price? All right, well, here's the graph of the price of Bitcoin. That's in blue. Google Trends search for cryptocurrency is in red. And you can clearly see here that those two things go together, right? So in other words, when the price of Bitcoin goes up, people care. And when the price of Bitcoin goes down, people don't care. And so that's why I say that most people only care about Bitcoin because of the fact that the price is going up, and that's pretty much all they care about. All right, so what's some technical problems with Bitcoin? So I'm going to talk about the problems. So the good things about Bitcoin has a limited supply, the price has gone up. So what are some of the technical problems? So technical problem number one is that Bitcoin only has the capability to do about 3 to 7 transactions per second. Right, so this is number of transactions that take place per day for Bitcoin. And you can see it's basically popped out at like 400,000 transactions per day. It's more around 300,000 transactions per day, which if you back it out, it's about 3.5 transactions per second. All right, so just to give you some relative idea of how many transactions that is, credit cards can do 5,000 transactions per second. All right, so if you're comparing the ability of credit cards to do transactions versus Bitcoin, obviously Bitcoin cannot even do close to what credit cards can do in terms of number of transactions. All right, so that's issue number one with Bitcoin. All right. The other issue with Bitcoin is it requires an incredible amount of power, right? We were actually talking about this right before we started the webinar. Why is China shutting things down? Well, one of the reasons they're shutting it down is they have a power crisis, right? And Bitcoin takes up a lot of power, and they need that power to harvest crops and other things that they need for their people. And that's one of the reasons they're shutting it down. right? You can see Bitcoin here goes ahead and uses more power than Norway, Switzerland. It uses 10 times more power than Google or Facebook, almost uses 10 times more power than Google and Facebook combined, right? So although it's a minuscule amount of power compared to the US or China, it still uses a lot of power. Now, I'm sure people point out, number one, that there's a network around Bitcoin people are trying to do to speed up transactions. We're talking about maybe forking Bitcoin, and I'll talk about what that means in a moment. So it uses proof of store instead of proof of work. That might cut power consumption. But as Bitcoin stands right now, those are the two major technical problems with Bitcoin. If we think about financial issues with Bitcoin, we're up to about 19 million coins have been mined. Please note it has a maximum of 21 million, which means there's only about 10% more supply to go from here. If you look at your change in supply over time, you can see that what happens is it used to be about 25,000 tokens per week were created. Then it got cut in half to 12,500. Now it got cut in half again. So it's about 6,000 tokens per week. And just like gold, Bitcoin can never be an actual currency because if everything was priced in Bitcoin, we'd have guaranteed deflation. That's one of the problems with a fixed supply currency, right? Our economy will grow faster than Bitcoin will grow. And in fact, it might be already growing faster than Bitcoin can grow, which would guarantee deflation if it became our, say, national economy currency, right? So it's got that gold problem I talked about earlier, all right? Other issue with Bitcoin that's financial. So this is your daily change in the value of Bitcoin in 2021. So each one of these bars represents a daily return. All right. So this is the value of Bitcoin. So can you imagine if you had all of your money and your salary and everything tied up in Bitcoin, and you had a day where terrific, your value went up by 17%. And of course, later on, you lost like 15% of your money or 12% of your money in one day, right? It's just not stable enough to be a currency for people. And just to give you an idea, if you look at the value of the dollar versus other currencies in the world, you can pretty much see this is the volatility of the dollar, which is our currency, right? And if I flip back and forth, I use the same y-axis, you can see that the volatility of these things aren't even close, right? So Bitcoin just financially can't be a currency because it's just too risky. It's not a store of wealth because you have no idea what your wealth is going to be worth the next day. Sometimes it's good and sometimes it's bad. All right, and for these reasons, people aren't adopting it for a currency. So this is UMW is a mortgage lender. You can see they decided to start accepting Bitcoin. It just announced a few days ago that there's no demand to use Bitcoin to pay mortgages. They had one home mortgage payment in September and 5 more in October that were settled in crypto. By the way, this is the second largest mortgage lender in the United States. So I'm not talking about like some mortgage lender with like 30 loans. This is the second largest mortgage lender in the United States. Basically says that nobody wants to use Bitcoin as money. All right. So it's just not going to be there. All right. So what is Bitcoin if people don't think of it as money? And if you go to CoinDesk or whatever it is, yeah, I think it's CoinDesk I got this from, maybe it's gold. In fact, if you look at the value proposition here, it says it's digital gold. And so, is it digital gold or not? From the standpoint of it's got a limited supply, it's kind of like gold in that way. But if you look at all the return properties, it doesn't look like gold. So this is a kind of a dot plot. So this is gold returned on the x-axis, and this is Bitcoin returned on the y-axis. These are daily returns. You can see there's a slight positive relationship between them. This is not statistically significant. So basically, the returns between gold and Bitcoin are completely random. If you look at in terms of hedging, Bitcoin versus the US dollar, right? So Bitcoin's supposed to be this hedge against the Fed doing crazy stuff and making the dollar useless. You can see here again, there's a slight negative correlation, which is what you'd want, but again, it's not statistically significant and it's weaker than actual gold. And really all you have here when you're looking at Bitcoin is you basically have a stock, right? So this is the relationship between the return on the S&P 500, a major stock index, versus Bitcoin return over the last 2 years. You can basically see it's a linear line that goes straight through versus gold is more uncorrelated with the stock market, right? So you can basically think about Bitcoin as as a stock with what we call a lot of idiosyncratic risk, right? Where it's related to the market, but there's a lot of noise in it, right? There's nothing really special about Bitcoin. It's just a risky stock, right? Right? Would it be good to be gold? So this is, one of the things I always like to do when I'm thinking about something. Like even if Bitcoin was gold, let's say it was gold, is that a good thing or not? So gold had this big upshoot after we went off the gold standard in 1971. I have no idea where Bitcoin is going to peak. I just lined it up here with the peak in 1980 for gold. And you can see that once gold peaked in 1980, it took over 20 years for it to get back to where it was before. In fact, it wasn't until 2004 that gold went back to the price it was in 1980. All right, so I'm not sure whether or not it's a good thing if Bitcoin is actually gold or not, because there's over 20 years of no return. And if you think about gold, no corporate treasury owns gold. Like there are very few people that are invested in gold. And so really, if Bitcoin really is gold, do we care? Because most people don't seem to care about gold as it is now. And so that's an open question. One of the most disturbing things for me about every cryptocurrency, so let me stick to Bitcoin, I'll talk about other cryptos here in a moment, is basically you can always change the code, right? So if you've seen the matrix, there can be a glitch in the matrix here, right? And so, you ask people, well, what happens when Bitcoin runs out of coins, right? How are miners going to get compensated? And always the first thing that you see here is that, well, they could just change the code to allow more than 21 million Bitcoins, right? In other words, all Bitcoin is a computer program, and you can update the computer program so it allows more than 21 million coins, right? So they call this forking when they upgrade the computer program. So you could, it's just, they change the code and they change the rules. And I'm not saying they will, but there's that ability where you buy Bitcoins and, it could be one day they decide, well, we need more than 21 million Bitcoins. And so we can just make some more. And then of course, that whole idea that it's of limited supply goes away, right? The other thing to note about Bitcoin is it's really not decentralized. So 2% of people own 95% of all Bitcoins, right? So this idea it's decentralized and you're sticking it to the man. Well, I got news for you. The man actually pretty much owns all Bitcoin already. So it's controlled by 95% of accounts. Anonymous transactions mean you can do a lot of illegal stuff, right? So there's been over $5 billion in ransomware payments already in 2012. I'm not saying that you can't do illegal stuff with other currencies, but certainly this makes life a little bit easier. And so that's one of the issues that you have with Bitcoin. And so really, what do I think is Bitcoin's future? Well, I think obviously there's a lot of regulatory risk. And, people talk about China outlawing Bitcoin, and it's a little easier for China to do it than here. But, back in 1933, you can see here on the right, we actually outlawed the private ownership of gold here in the United States. So it's not unprecedented that even here in the US, we've outlawed your ability to own something that people thought acted like money. And by the way, we were on the gold standard in 1933. So gold was actually money in 1933. It seems very goldish to me. It doesn't seem like it can actually act as money. What happens if mining is worthless? You need the network to survive for you to actually have a currency. So what happens if you go to proof of store or something else and the mining's not worth very much, or there's no more Bitcoins, who's going to pay for the transactions? You hear people like Kathy Wood talk about 500K for Bitcoin. That seems crazy to me. That would be worth more than half the stock market if it was at that value. I just don't see that happening. And really, given it's a commodity, it's not a commodity, collectible, or financial asset, really the question becomes, who's going to keep the price going up, right? Bitcoin has no intrinsic value. I know that's tough to hear, but it really has no intrinsic value. That doesn't necessarily mean a bad thing. A $20 bill in my wallet also has no intrinsic value other than we agree it's money. But it requires people to believe that Bitcoin has value for it to be something rather than ownership in a company where I know I'm going to get cash flows from it. All right. Now, I'm sure many of you are saying, well, Chris, wait a minute here. All these finance firms are adopting it's going mainstream. Well, this is a quote from Jamie Dimon from JP Morgan. I personally think that Bitcoin is worthless, but I don't want to be a spokesperson. I don't care. It makes no difference to me. Our clients are adults. They disagree. That's what makes markets. So if they want to have access to buy or sell Bitcoin, we can't custody it, but we give them legitimate, clean access as possible. Right. So let me translate that statement for you. No matter what happens to JP Morgan's clients, if they make or lose money, JP Morgan is still going to make their money. They couldn't give a crap if the price goes up or down. They just want people to trade it so they can make money. All right. And just look at Robinhood back in quarter number 2. They made $233 million from people trading crypto. Right. These firms don't care if the price goes up or down. The only reason they want the price to go up is so more people buy and they make more money. They don't really have any long position or whatever in crypto. They're just happy to serve their clients because that means that they make more money. So whenever you see like this ETF company, they're just excited to make money. They could care less whether or not Bitcoin makes you money or not. They just care about making money for themselves. All right. So Bitcoin's been an amazing idea. So what the hell? Let's make some more, right? All right. So of course we launched Dogecoin in 2013 in December. Then we launched Ethereum in 2015. And now there's over 7,000 other tokens that we have here. So, I mean, why not? I mean, Bitcoin was such a good idea. We can't make any more Bitcoin. So what the hell? We can just make more tokens instead. And by the way, this is the complete opposite trend of everything in real finance. So if some of you remember your history, we actually had the Articles of Confederation here in the US before we had the Constitution. And one of the reasons that it failed badly is because every state had their own money, right? Imagine that every time you went to Vegas or Seattle or whatever, you had to change your money at the border. That wouldn't be a very healthy economy to be in. And if you look at Europe, I mean, on the left is Europe pre-2001. If you went to Europe, there's a joke that if you went around Europe, you used to lose half your money just exchanging it from one currency to the other. And then you can see on the right what the euro's done. So this idea of just creating a bazillion currencies is completely opposite of everything we've tried to do in finance, which is to have reduced number of currencies to reduce transaction costs and exchange rates. I mean, just to give you an idea, 7,000 cryptocurrencies, there's only 4,000 publicly traded companies here in the United States. There's only 175 real currencies. And if you had an exchange rate for every cryptocurrency against every other cryptocurrency right now, you'd have to keep track of 25 million exchange rates, right? So does that really sound efficient to you? I'm gonna, hopefully you're gonna say no. I mean, most people have trouble exchanging one currency for another, let alone keeping track of these 25 million. All right, so of course, and some of these are amazingly useful currencies. I mean, you could go down the Tulip City, which of course, the tulip bubble, the Netherlands was the biggest bubble in history. I mean, maybe Ponzi coin, I guess that's run by Charles Ponzi, I'm assuming, where you get to lose all your money. I really enjoyed this coin, the nothing coin with the ticker nada. I mean, at least they're being truthful here, right? And then of course you have the bubble coin, which is great. I mean, maybe it's too fattening, right? So you got the original Bitcoin, but you can go on a diet Bitcoin, right? You can have some Bitcoin lights. And now they came out with a new flavor, Bitcoin Zero. I mean, so that's just as tasty as the next one. And I know I shouldn't go here, but I'm going to, right? You got the adult Bitcoin, for those that are 21 plus, right? Because the adult Bitcoin, you can meet porn stars, all right? You can do it in a doji position, doji style, and you can get herpes or you can get some of Elon's sperm. These are actual cryptocurrencies. I couldn't make this up. I'm a finance PhD. So there you go, right? These are some of the 7,000 amazing cryptocurrencies you can invest in out there now. And just to give you an idea, if you look at how much crypto is being created, right? While Bitcoin itself has a limited number of tokens, most cryptocurrencies actually have no limit on the amount of tokens that can be created. And so what you do is if each week you take the tokens created, you convert them using your exchange rate into Bitcoin, and you add up the total supply of crypto in Bitcoin terms that's being created, you can see here we've gone from 10 million coins to almost 90 million coins over the last 8 years. In fact, this year alone, supply is up 38%, right? So this is in Bitcoin terms. I'm not adding like worthless coins in here, like worthless coins are worth 0 Bitcoin. This is based on, big cryptocurrencies like Doge and everything else that's constantly being created, right? In other words, the stuff is not rare. It has an unlimited supply. As you can see, it's incredibly easy to make a new cryptocurrency, right? I mean, there's 7,000 of them, all right? If you want to compare this to the Fed, right? So the red line here is the size of the Federal Reserve balance sheet, how much is expanded, aka how much money the Fed's been printing versus how much the crypto people have been printing in blue. You can see the crypto people have printed a lot more money. Sure, since COVID started, crypto is up 60%, Fed's up 100%, but trust me, crypto is going to catch up probably in the next 6 months. And so really, again, Bitcoin has limited supply, but all these other cryptocurrencies don't. Right. And so if you look at the purchasing power of the dollar, right, inflation since the beginning of this, since 2013, you can see the value of a dollar again. If you had $100 back in March of 2013, now you can only buy 90 something, was it $84 worth of stuff, right? Because they made more dollars. Well, we're making tons more crypto, but for some reason, all of that has become worth way more money. In fact, the total value right now, the crypto market's about $2.5 trillion, right? So this idea that more supply equals higher price makes zero sense in economics, right? It just makes zero sense. If something has an infinite supply, eventually it becomes not worth as much money. I mean, that's what my 1980s baseball card collection taught me. All right, so most crypto versus Bitcoin is pretty much the same, all the things I talked about before, but it's different, all right? You always have to have a James Franco meme in all of your presentations. I think it's by law. All right, so most cryptocurrencies are similar. Usually the biggest difference is that they can have an infinite supply. So there's no supply limits on Ethereum or Doge. They have no supply limit. Some of them have things that sound pretty cool, like integrated smart contracts. So what's a smart contract? It's just essentially computer code that executes something when something happens. So the idea is, if someone ships you something and when it gets delivered to you, you confirm the confirmation and then the smart contract sends the money. You can set it up so like every year, your contract sends money to somebody on their birthday, things like that. And then there's another set of things called stable coins. And these are essentially like money market funds. You can easily move money between cryptocurrencies, right? So the idea is a stable coin is always worth the same amount of US dollars. All right, and I'll talk more about that here in a moment. All right, so talk about Ethereum. It's the second largest cryptocurrency, about $450 billion is the total market cap. Again, it doesn't have supply limits. It's digitally controlled over time. But in theory, it has an infinite supply, just like the US dollar does, right? So over time, in theory, Ethereum should become less and less valuable for each particular token. It does integrate smart contracts, which I think is the biggest appeal of the currency. One of the reasons it's more kind of popular, I would say, right now than Bitcoin in the actual community. I will note that it can do, I think, 20 or 30 transactions per second, right? So it has the ability to do more transactions than Bitcoin. I think it's 30, but I could be wrong on that. So I'll admit that I could be wrong on that. But it has the same issues in terms of return properties as Bitcoin, right? So of course the price has gone up a lot, but you can see it's not a hedge against the dollar, and it looks a lot like a stock, right? So again, these are just basically risky assets that trade along with all the other risky assets in the world. All right, then you have something called Dogecoin. I'm going to get back to the smart contracts in Delphi here in a moment. Dogecoin, really, honestly, it has no reason to exist. There's no reason for it to exist, right? There really isn't. In fact, if you go to coindesk.com, literally the only thing it can come up with is meme coin as the value proposition. The value proposition is literally a joke. There's no reason for this thing to exist. All it is out there is to sucker money out of people, right? So this is a graph of the number of downloads of the Robinhood app. Those are in gray. This is the price of Dogecoin over the year. You can see pretty much price spikes. People get suckered into buying it and then lost their shirt. And that's pretty much the story of Dogecoin. And yeah, did some people get incredibly rich? Sure. But a large majority of people just got slaughtered buying Dogecoin. There's no reason for it to exist. And someday I'm sure it won't, but we'll keep it alive for a while so we can rip some more people off. Stable coins. So stable coins, as I mentioned, are generally locked to the value of the US dollar. All right, so the idea here is you take your US dollars, you put it into a stable coin, and then with that stable coin, you can easily transfer it to any other cryptocurrency, right? So you take your US dollars, you put in the stable coin, right? So $1 US equals 1 tether. I'll just use a real example here. That's the most popular. And then you can take that and you can turn it into Ethereum or Doge or Bitcoin or whatever you want, right? So it's an easy way to get into the crypto infrastructure and then switch things around whenever you want. In theory, I'm going to use the word in theory here, there's $1 in reserves for every stable coin that's created. And I'm not really sure that this is true. And pretty much everything so far says this is not true, right? So if you look at Tether, for example, just to give you an exact idea, so this is the price of Tether over time. So you can see there's some bumps in the road here, but generally speaking, you can see it's stayed pretty close to the value of $1. Right? If you look at a number of Tether coins out there in the world, it has really spiked here in August. It's kind of like the backbone of the crypto system. Everything goes through Tether. And you can see here that it's gone from 10 billion to $70 billion very quickly. But there's a lot of questions about whether or not Tether actually has $70 billion sitting around. Pretty much no one can find $70 billion sitting anywhere in the banking system, right? So unless they bury the $70 billion somewhere, it doesn't exist. And of course, just recently, they had to pay a $41 million fine for claiming it was fully backed by US dollars when it was not. And then just more recently, one of the major investors in Tether, so they have an incentive not to disclose this, came out and said that basically that instead of taking US dollars and depositing them to get Tether, you can just deposit other cryptocurrencies and they'll create new Tether coins for you, which of course is completely against the idea of Tether, right? So there's this big question mark about whether or not these stable coins are really backed. And of course, this is an incredibly important issue because if everyone tries to go back and claim their US dollar at the same time and the reserves aren't there, pretty much the whole stable coin system is going to collapse, which would be obviously a huge problem. All right, so what's crypto's future? And I'm sure that there's probably a lot of people that would completely disagree with me, but I personally feel almost all these coins will ultimately be worthless. All right, so I challenge anyone out there to tell me why Doge needs to exist when Ethereum exists. Like why does Doge need to exist other than you can trade it and try to get rich quick, right? Getting rich quick is non-answer. Elon tweeting about it is non-answer. The price has gone up is non-answer. The price has gone down, it's got to go back up. It's not an answer, right? That is not a reason it needs to exist, right? It's really hard to find use cases for crypto that are legal. And I'm going to come back to that in just a moment. I think Bitcoin, because it's got a limited supply, which is pretty rare, and Ethereum, which has these kind of smart contracts, seem to have the best chance to survive. But again, I think, most of the other 6,998 plus and growing cryptocurrencies just don't have much of a chance. And personally, I've had a lot of debate about people with Delphi, and I don't think it's as great as people think it's going to be. And I'm going to explain why here in a moment. All right. So what's Delphi? I think we're at, I'm almost done here. Got maybe 3 or 4 more minutes. So if you got some questions, throw them in the Q&A. There's only 2 questions in the Q&A and over 100 comments about how I'm stupid, I'm sure, in the chat. So if you have some questions, throw them in the Q&A. But really, this is kind of how finance works today. All right. So you got me over here. I place a trade for stock in my Robinhood account. That gets routed to the New York Stock Exchange. You got Gordon Gekko over here. He goes through Schwab because he's old. That gets routed to the New York Stock Exchange. The New York Stock Exchange does the trading for us. And then these 2 companies hold the stock for us, right? And that's really how trading works today, right? What decentralized finance is going to do is it's going to eliminate all this crap in the middle. And basically, Gordon Gekko and I are going to trade together, right? So I'm going to buy stock directly from Gordon Gekko, right? So the idea is, well, all these people are just charging us a lot of money. They're fat cats getting rich off of what we're doing. They don't do anything. So let's just get them out of the way, and then we can do it directly, and we're going to save a bunch of money, and we can do whatever. I think that's the argument. All right. And so, when I think about the pros and cons, I mean, the biggest pro is, if we cut out the middleman, right, we're going to save money, right? If I don't have a mortgage broker and a bank and I borrow money directly from somebody for my mortgage, well, that's terrific, right? I don't have to pay like all those fees I have to pay to make the loan. Or if I do this, I don't have to pay for the stock, right? I can just trade directly with Gordon and that's going to be fine, right? So I'm going to save on fees. But really, the middlemen do a lot. Like, I know that people here don't think the middlemen do a lot, or the middle people, I should say, but they actually do a lot, right? So, that's really kind of the issue. People don't understand like all the stuff that's put in the middle, back in the 1910s and the 1900s and the 1890s and the 1920s, we didn't have any of these systems in place. And pretty much it was the Wild West of finance, and the whole thing came crashing down in 1929. And by the way, there was no Federal Reserve in 1929, so you can't even blame it on a centralized system, right? There was no Fed in 1929. There was no centralized system. And so these middlemen were created to do kind of middle people created to do a lot. So number one is they reduce or eliminate search costs, right? So right now, if I want to buy stock, I have to go find Gordon, right? Like maybe there's a crypto exchange that has it listed, but there's going to be a bazillion crypto exchanges, just like there's cryptocurrencies. Everything's going to be segregated. How am I going to find the best price, right? 2, reduce price because all the supplies in one place, right? So you get like consistent pricing across everything. Reduce asymmetric information. Like, should I trade with Gordon Gekko? Like, imagine if I'm trying to trade directly with Goldman Sachs. Do you think Goldman Sachs with their real-time satellite knows more than I do? Probably. So I'm going to get hosed, right? They're probably going to remove counterparty risk, right? So there's always a huge chance when you do direct transactions that things don't work out. And yes, you can create smart contracts and blah, 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 but smart people are going to find a way to defraud the system, right? And so really these middle people do a lot. And that's really the kind of the crux and the armor here for these Delphi applications is they sound great at small scale with really smart people that are interacting with them. But imagine if you don't have really smart people interacting with them. And Delphi doesn't really count for these issues, right? So you see, oh, I'm getting 6% interest on my loans. Well, of course, you're getting a lot of risk for that 6% interest. Why are you getting twice as much interest as a mortgage? Do you think it's free money? Do you think everyone's that stupid? Of course not. There's a lot of inherent risk in the system that you're not accounting for. More generally, when I look at Delphi and I think about finance, this is really my problem. What problem is Delphi trying to fix? I mean, and I ask that honestly, right? So if I think about yourself, right? And think about the financial system. What fees do you pay, right? Because in my financial system, my checking account is free. I mean, I don't use an ATM really. I mean, we use Venmo and everything else. And if we do direct bank transfer, there's no fee, right? I don't pay overages because I budget myself, right? Venmo is free, as I mentioned, from a bank account. PayPal is free from a bank account. If you do PayPal like corporate, there's a 3% fee, but a lot of that offers protections, right? So like seller protection, et cetera, right? I pay off my credit card, so I don't pay any interest fee on my credit card. When I charge things at Target on my credit card, I don't pay anything for it. To trade Apple stock costs me 0.03% of the price. You think it's going to get cheaper than that if you use Delphi? I have index ETFs in my 401k, et cetera, and I pay 0.04% fees on that per year. Do you think that's going to get cheaper with Delphi? So what problem is it trying to fix, right? That's the real problem, right? Because I don't know what the problem is that it's trying to fix. And people are like, well, it's faster. I can instantly transfer $65,000. Well, all that slowdown is to keep illegal activities from happening. All right. So that's really the slowdown, right? If you transfer over a certain amount of money, it gets checked by that financial system to make sure it's not like drug money or something else. Right? These are the real problems in finance, and Delphi doesn't really do anything. And in fact, Delphi, I think, will just amplify the difference in financial literacy. People don't know the value of education. People don't really know how to use their credit cards, bank balances, et cetera. People use payday loans that have 400% APR. People spend too much, they trade too much, they're overconfident in their financial decisions. And these are really the problems that we have in finance that really cause people problems in terms of money. And none of these are going to be corrected in Delphi. If not, most of these will be exaggerated in Delphi. All right. So in conclusion here, current cryptocurrencies, I think, are very hot right now, of course, because the price has gone up. The long-term future of fad. Unlike many cryptos, maybe I don't think most of them have a future. Even if they do, like Bitcoin and Ethereum, you're not going to be getting like 1,600% returns anytime. They're just too big now. Too many people know about them. Too many people are really going to trade them already in it. And I think, honestly, my honest opinion, I think that most of the useful parts of Delphi are just going to be integrated into our existing financial system, right? It's just going to be like Facebook buys Instagram, and that's going to be the end of Instagram, right? It's too easy for them to do it. It's too cheap for them to do it. And I think the crypto ecosystem, it needs to be careful because it's incredibly integrated. If a tether goes down, it all comes down, right? And that's something that needs to be done. All right, so there's a few questions before, so I'm going to do my quick FAQs here, and then I'll get to the real questions. The moderators are going to pick questions for me. So let's get started with these excellent questions. And I'm sure a lot of people disagree with my take, but Chris, my wife's cousin's friend's college roommate's kind of sort of uncle made a ton of money buying Dogecoin last year. Does that mean I'm going to make a lot of money now if I buy it too? And so my comment is no. There's a huge difference between luck and skill. Just look at Kathy Wood from ARC. No one admits they ever lost. So one of the biggest things that I think that people don't understand is there's huge selection bias. No one ever goes around being like, oh my God, I lost 80% of my money trading Doge, or oh my God, I lost all the money I put in my Robinhood account. They only brag if they made money, right? Unless they're looking for attention on like TikTok or something. All right. And just because the price doesn't go up doesn't mean it's going to keep going up. So lots of people made money in WorldCom in 1999. Does that mean you should have bought WorldCom in 1999? Of course, if you don't know, WorldCom went bankrupt in 2000. So just because something has gone up, it definitely doesn't mean it's going to keep going up. You have to have a good reason to buy it. You can buy for the greater fool theory, but that's not really a long-term investment hypothesis. And then you have to get lucky. What would it take for you to buy into the crypto hype? I honestly have to see some real applications. You can see I've really thought about this a lot. And I don't really see any real applications where it adds value or diversification to my existing portfolio. The price has gone up a lot, sure. I won't argue with you on that, but that doesn't mean the price is still going to go up. It doesn't matter that Dogecoin went up from less than a cent to even at 25 cents where it is now. It matters where it's going in the future. And I don't see where a reason that Dogecoin is going to go up. So I'm going to use Dogecoin as an example because I think that's just a worthless cryptocurrency. Should I buy crypto and how much should I buy in my portfolio? So my honest opinion is, if cryptocurrency is really a currency and Bitcoin's really gold, then I'd say for most people right now, you should have as much crypto in your portfolio as you do euros and gold. I'm going to guess almost nobody on this call has any euros or gold in their portfolio. So if you don't have those things in your portfolio, then why would you think about having crypto, right? And if the answer is just because the price went up and I have FOMO, then that again is not an investment hypothesis. All right, so with that said, we got 10 minutes to go here, and I'm sure there's some questions. So I'm not sure who's doing the question and answer, but go ahead, fire away.
Awesome, thank you so much. You covered a lot of ground. Good reality check in a lot of ways. So we had a few questions, in queue, but I think you covered a lot of them in your Q&A. One question we had was, can you explain why deflation caused by a limited supply currency is bad? Would that necessarily cause a continuous downward spiral in prices?
Yeah, so I think the best example is to look at is like a place like Japan. I mean, people point out Japan all the time as a place that's kind of had zero inflation or deflation. So, I mean, there's two reasons that deflation is very problematic for economies. So let's go back to the Great Depression. All right, so problem number one is if I know that a house is going to go from $1 million this year to $800,000 next year, I'm not going to buy the house this year. Right. So in other words, deflation or expectations about deflation actually reduce demand for the economy, which makes deflation a self-fulfilling prophecy. Right. Because next year I'll think, oh, the 800 grand house is going to go to 700,000. I'm going to delay my purchase again. The second reason it doesn't work is if you have a leveraged economy. right? So loans are in nominal terms, right? So if I buy a house for $1 million and I get an $800,000 loan and I'm working and all of a sudden, well, prices that people are paying for stuff goes down, so I have to take a salary cut. Well, my mortgage stays the same, but my salary keeps going down and the value of my house keeps going down. So I'm not going to pay my mortgage anymore, or I'm not going to be able to afford my mortgage anymore on a default. And then that's kind of like how it happened in 2008 and the Great Depression, where then you put a lot of issues with the banking system, right? So, and those are really the two ways that deflation are pretty harmful to a modern economy in terms of supply, demand, and the banking system.
Thank you. We have a question here about what your thoughts are regarding use cases for blockchain technology. So, I mean, you said that it's difficult to come up with a use case. Can you hypothesize?
Yeah. So please note, I'm talking. The talk was about cryptocurrency, not blockchain, right? So cryptocurrency is just an application of blockchain, right? So the way I kind of view blockchain, if I were to put this simply, is it's kind of sort of have how encryption works on the World Wide Web to a certain extent. Which is, you can imagine that when you do a transaction with your credit card, you have what are known as like public and private keys. And that's how you transmit the information that you can see. It gets encrypted and it goes to the other side and they can see it, but nobody in between, right? So there's lots of applications for inventory, supply chain, health, et cetera, where people are trying to transmit information or making sure goods and services are correct, that blockchain is a terrific application for. The question tonight was really, is crypto a great application of blockchain? And I'm not sure it's the greatest application. I mean, I could be totally wrong. It wouldn't be the first time in my life. But I think that's where the question really is. So.
Thanks. And kind of drawing together a question from a number of questions, sort of on a theme, regardless of the intrinsic value of cryptocurrency, and all the arguments you made, it's still being traded a lot, being used a lot. People are into it. So what are we expecting kind of on the regulatory front? And how can people kind of expect to interface with cryptocurrency and the government moving forward?
Yeah, sure. So, I mean, since Bitcoin's at $64,000, I'll say that's really the $64,000 question, right? I think the regulatory question is the big one. And the reason, so the reason it doesn't have regulation now is it's kind of fallen into this regulatory hole, right? So if you're a commodity, there's one group of people who are your regulator, right? If you're security, then there's another group of people who's your regulator. If you're a currency, then there's another group of people who's your regulator. And so since crypto is really not a currency, it's not really a security, and it's not really commodity, there's no existing regulation for it. And so, whatever they do to regulate it is going to be, and how they regulate it's really the question, I think, in terms of its value, at least here in the US. I mean, it could be that in El Salvador, it's still the greatest thing since the bread slicer, but here that it could be just people are outlawed from using it. So, I mean, you just don't see that many people using it as currency. I think most people just use it as a speculatory vehicle to try and make money, right? I'm assuming probably not many of the people on the call are creating Delphi apps. There's a few. So if you're making one, I'm not picking on you personally, but I think most people care because it's making money.
Thank you. Yeah, I'll collect my $64,000 then for that question.
Yeah, exactly.
It's a bit off topic, but I think, I don't know, we're going to have another one of these events. So a lot of people are asking about NFTs. Do you mind giving a couple of lines about NFTs, how they differ from cryptocurrency for people who might not know?
Sure. So I mean, NFTs are, I came up with what NFT stands for, and I won't say the middle term on the other one, but so NFTs, NFT is basically a way to digitally store that you own something. All right, I think that's the easiest way to put it. So the big application is someone buys a piece of digital art, and they buy it as an NFT, and then it gets logged that they're the owner of that piece of NFT, right? And so, I don't understand, we have something already that exists that you use to say that you own something. We call that copyright, right? So you put a copyright on something, and that then you own it, right? I mean, that's the way it works. I don't know how NFTs solve the problem that, if you have a copyright on something and people use it on the internet, there's really no way for you to get compensated, right? So this started with music, and now, people use movies for memes. I use it all the time and I don't pay anything. So I'm sure somebody will come knocking on my door tomorrow. But in any case, I don't think there's any way that it solves that particular problem. And then I don't really, I'll be quite frank. Why would you pay money for a video to say you own it that you can watch on YouTube and everyone can watch on their phone. It's not like a Picasso. Like you buy a Picasso painting and yeah, people can buy posters of it, but it's not the Picasso painting, like with the oil and everything else on the wall, or it's not like a Mickey Mantle 1952 baseball card. It's like, great, it's a picture on your phone that you can show to everybody. And then, you know, I don't think anyone at a bar, like you go to somebody, hey, look, I own this like amazing Tom Brady NFT card I bought for 3 million. I mean, is someone going to go to the blockchain and verify that you own it? I mean, it's not like, you know, if you have actually, you know, a Ferrari outside. So, I mean, I honestly, I just don't get NFTs. I presume they're the new uncut diamonds and people use them for money laundering, or people who just have an incredible amount of money and have nothing better to do. But I honestly, I mean, if I can't explain Dogecoin, there's no way in hell I can explain NFTs. I'm just going to go ahead and, you know, I don't understand. I'm still waiting for the world to end and everyone trying to access their crypto wallet with no cell phone reception. So I'm still waiting for, I want to see that scene. That'll be a good scene. Yeah, exactly. Nicholas has it right there. He says, invest in ammo. And when the end of the world comes, everybody, we will be on the lead standard. The people with the ammo will own everything. Have you seen The Walking Dead? Anyway, go ahead. Next question.
Always end on the note of zombie apocalypse. You know, that's my motto. So
there you go.
You know, I think that's about our time. I think we've covered a lot of ground, a lot of the questions that we've talked about. So thank you so much for an awesome program. Thank you everyone for attending. You know, please do keep an eye out for future programs and events. We have a Young Alumni virtual mixer on November 3rd. Keep an eye out for that. Our adulting events will be quarterly again. Next one will be next quarter. I don't really know what the next one is yet, but keep an eye out for that. It'll be equally exciting. Maybe not equally. Hard to follow this, but it'll be exciting. A recording of this webinar will be provided in a thank you email that every registrant will receive within the following week. If you do have follow-up questions about this or our events or about us, you can reach out to us by email at alumni@uci.edu. So everyone, thank you, stay safe, beware of zombies.